Yo, what's up, my people? How y'all doing? Once again, it's your boy Devin B representing Black Diamond FX in the building. And I'd like to thank you guys for tuning in. Tonight, we will be going over market structure and how we use it, with this ICC style trading strategy. All right. But before we continue, do your boy a favor, a solid one. Go ahead, smash that thumbs up, that like button, hit the subscribe button, share this with about 10,000 of your friends on all your platforms, your Discord, your TikToks, Instagrams, your Facebooks, even send it in a text message if you can. Let everybody know your boy, that dude Dev, is here, all right? And show some love. So tonight, live, we will be looking at market structure. All right, give me 1 second. All right, so those of you already know the market move in three general directions. Okay, so we have an uptrend. All right, we have a downtrend. And we have what's called consolidation. All right, now in an uptrend, the market moves like this. Boom, 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 boom. All right, until it reverses. In a downtrend, the market moves like boom, 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 until it reverses. All right. And in consolidation, the market will move. Doom, 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 doom. All right. Pretty much making bouncing in between support and resistance, or ceiling, or floor, whatever you want to call it. All right. So let's take a look, because being able to recognize market structure is very important for the way that we trade our ICC trading method. All right. So first, we're going to look at the uptrend. All right. So in the uptrend, this is what we have. Market comes up and it pulls back. Market comes up and it pulls back. All right. And it continues to do that until it decides to reverse. All right. So what we get is the market starting here at a low point. All right. Then it goes up and it makes a high. So you got a low and you have a high. So then the market retraces or pulls back down. Doom, 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 doom. All right. And it makes a higher low. And this is called a higher low because it's on the low side of the candles. However, it's higher than the previous low. All right. Then the market will give you that impulse up, and it's going to create a higher high. And this is a higher high because it's on the high side of the candles and it's higher than that previous high. All right. Now, something else that you need to note is every time the market pulls back and it starts to go up and it breaks this previous high here, that's called a break of structure, or a BOS. All right. A break of structure. All right. And you're going to see it happens. It's going to pull back down again. Boom, boom, boom. Give you another higher low. Once again, because it's higher than the previous low. And don't, 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 don't. It's going to break structure here. All right. And then keep on going until the market decides to reverse. All right. And that is the basics of your uptrend. All right. Market is going to move in a general up direction. Okay. Now we have a downtrend. All right. So in a downtrend, the market is going to go whoop, whoop, down, pull back, down. All right. And that being said, just the opposite of the uptrend, you're gonna start from a high. All right. Then the market is gonna create a low. All right. Then it's gonna go up and create a lower high because once again, we're on the high side of the candles, but it's lower than the previous high. All right. Then it's gonna lower low right here. And it's on the low side of the candles, but lower than that previous low. All right. And same thing like this. Once we break as it's coming down and it breaks this low point, you're going to get a break of structure or BOS. All right. And the market will continue, make another lower high. All right. Go down some more, make another lower low until the market decides to reverse. All right. And this is your basic downtrend. All right. We can also look at consolidation. All right. So when we're looking at consolidation, the market will look something like this. You're going to have a ceiling or resistance. You're going to have a floor or support. All right. And you're going to see how the market is going to You might get a little spike out, but for the most part, that's how it's going to and continue like that until you get a real breakout in either direction. All right. We don't trade consolidation. All right. We wait for price to break out of consolidation. Oh, wait, hold on. We wait for price to break out consolidation. If you try to trade consolidation, you will get smashed around. All right. Your nerves are going to be bad. Price is going to be bouncing all over the place. All right. So let's go to the charts right quick and take a look. All right. So if we're looking at this, now this is silver futures right here. Let's see. I'm trying to need to get this off. Trying to get this zoom thing off of here. All right. So watch, check this. Oh, I got it. All right. So check this out. So you can see here on the 5-minute chart, price goes from this low to this high up here. Let me see if I can find one that's a little more clear for you guys, because I want you to see the structure as well. Let's look at a Forex chart. All right, let's look at this one. So you guys can see this is a downtrend. All right. And you see how price is going. See how we go from the high to the low. Lower high, lower low. Lower high, lower low. Lower high. And it continues. All right. And it continues. You see that? And then we have, you can see, and then we have the breaks of structure right here. Break of structure. Another break of structure. Y'all see that? Boom. And another break of structure. And that will continue. Now that's your downtrend. On the uptrend, let's see if we can find an uptrend. A nice uptrend. Let's see. See something like this right here? You go down and up. Then higher low, higher high, higher low, and it goes all the way up here. Boom. All right, until the market reverse. All right. And the market is going to continue doing that until it reverses. Now, you guys keep on hearing me say until it reverses, until it reverses. What does that look like? Okay, let me show you guys. I'm gonna show you a bullish reversal and a bearish reversal. All right. So when we got a bullish reversal, put this bull reversal. All right. So a bullish reversal is going to look like this. The market is going to be coming down. All right. Then it's going to go bullish. Start going up. All right. Something that I want you guys to see. So on this side, when the market is bearish, we're going to get those structure breaks on the bottom side. All right. But then something unique happens. All right. As the market starts to come up, all right, and we break this high point, this last high point here, notice we go from breaking lows to breaking highs. All right. This is your first indication that the market will be bullish. And this is your change of character, or you can call it a shift in market structure or whatever. All right. But this is your first signal, that the first clue that price may potentially go bullish. However, in order for price to essentially go bullish and this to be a legit reversal, the low here cannot break this previous low right here. All right. If so, then the bear run continues. However, if it does break it and then it goes up and breaks this, gives you a breaker structure, now you have a confirmed reversal and you can start looking for your trades. All right. Now, some people start on this pullback here, this one. All right. Because a lot of times you see it might come a little bit deeper. All right. Sometimes it will, sometimes it won't. But I like to wait for that confirmed. Once it break here, once you get that breaker structure here, that's your confirmed reversal. Now you can wait for it to pull back here, somewhere up into here, take your trade going up. And that's your bullish reversal. All right. On the opposite side, you have a bearish reversal. So with your bearish reversal, bear reversal. All right. So on your bearish reversal, you're going to see price go dump, 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 dump. All right. Then all of a sudden, it's going to go down, dump, 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 dump. All right. So notice on the bull side, you're going to go from breaking highs. Going to get a breaker structure here, breaker structure here. Then all of a sudden, you're going to get a break of structure down here, which is called a change of character. Same thing. All right. Once you get it here, this is your first indication that price will go bearish. Now, once again, in order for this to be a bearish reversal, first of all, it has to break this. All right. Second, it cannot break this high. So price will have to go up, give you a failed break. All right. Failed to break. Come down, break this. That confirms your bearish reversal. All right. And then when price pulls back, you can start looking for your trade entry and then take it on the way down. All right. Now let's go to the charts and let's see what we got. All right. You can kind of see one right here. See how we went? It was going up. Boom, boom. I'm gonna screenshot it. And then I'm gonna put it in the let me screenshot it right quick. All right. Let's go to the whiteboard. And let's paste it. And we go stretch it out so we can draw on it like we want to. All righty. And just a little bit more. All right. So watch. So now let me find we can do it light blue. All right. So check this out. So notice how we get a price come down, up, down. See how we breaking? We breaking those highs right there, breaking those highs right there. But then look at what happens. Now it comes down here. Now some people might call this wick. They might call that a break. I don't. I like to see candle close. So technically, to me, this hasn't broke until we get this candle closed down here. All right. Now we get a break. Now we get a break. And look what happened. It came up. All right. And it failed to break this high right here. Failed to break that high. And then price started coming on down. We ended up, did we break this? Looked like we did. It was close. I guess I didn't get enough of the chart. But what'll happen is it'll come or consolidate or whatever and then start coming down from there. All right, let's go back and see what happened. Let's see how it started. See? Coming down. Now it did end up going back up. Did it break that high? Nope, didn't break. See, it came back up, still didn't break. It just consolidated. See it? And that's the next thing we were going to look at, consolidation. But here we have a whole consolidation right here. And then look, it just dumped. So that was a real reversal. Although it reversed right into consolidation, this is your consolidation. See right here? Watch. I'm gonna mark it. See right there? Look. Tap, 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 tap. See that? So price pretty much stayed within that range. And then it broke out. Look what happened. When it breaks out of, remember when I said we trade, we wait for price to break out of consolidation? Well, look what happened. Price broke out of consolidation, came all the way back up and gave you an entry right up in here. See that? Easy. If you learn market structure along with liquidity concepts, pretty much market structure, and understand, watch something. I'm gonna show you this because this is what I never told you guys. All right. When we get those pullbacks, say the market is coming down, up, down, up, down. All right. So now that you have a basic concept of market structure, understand these pullbacks, these pullbacks, these pullbacks, this. You think they pull back to a random area? No, they don't. Watch this. I'm gonna show y'all how I have become such a profitable trader. All right, let's look at an uptrend. So if I'm going up, come down, up, come down, up. All right. What we have is called trading ranges. All right. Now, each one of these legs can be a trading range. All right. Say for instance, this starts the range here. All right. Then it goes up. It goes up. It makes the high. There's the top of my range up here. Then you see price will start to pull back. All right. Now we have our range. This is our trading range from this low to this high. This is our range. When price pulls back, it pulls back to an area of what's called internal range liquidity. Okay, so you have internal range liquidity. I'm gonna just put that dollar sign, and you have external range liquidity. All right. So what's internal? Internal range liquidity is anything inside of this range, anything on the inside of this range, internal, and price will pull back to internal range liquidity. All right. Where's the external range? Well, if internal is on the inside, external is on the outside of the range, above the highs and below the lows. All right. So my trading, pretty much the way I trade from internal range liquidity somewhere along this range. Then I enter, and my target is external. Where's external? At the high, where we get the breaker structure. All right. Get in my trade right there. Boom. That's my target. All right. You can let it go. Now, once you get here, you can either get out your trade and then wait for another pullback to some more internal range and get in again. All right. Target external again. You can do that, or as it goes up, what you can do, say for instance, if you get in here, all right, so your stop loss is going to be here. All right. So as price goes up and pulls back, now you can move your stop loss up some. All right. Now you might move it to say break even. All right. And then as price goes up and surpasses this, now you can move it again. All right. And what I like to do, I like to move it to the lows. I like to use my structure and move it to the lows. All right. And it'll come down, go up. Once it break again, I can move it to here. All right. That's how I manage my trades until either price hits my stop loss and profit or it's going to hit my take profit. All right. That's how you manage your trades. All right. But that's how you do it. And it's going to look just the opposite in a bear market. All right. Just the opposite in the bear market. Now, I know I mentioned internal range liquidity and external range liquidity. So what exactly do I call internal and external range liquidity? All right. Besides just inside the range and outside the range. Okay. So internal range liquidity external range could be highs and lows. All right. Let's go to the chart right quick because internal range might be a little more complicated for you guys to find. Let's take a look at this. This is GBP CAD. See how price is moving? I'm going to screenshot this again, and we're going to take it back to the drawing board. And I'm going to show you. All right. Let's see. Make it big. All right. So if we're looking at this, you can clearly see, let me move this a little bit. All right. So you can clearly see we started, excuse me, we started down here. Okay. Then we came, all right, up, down, came up here. Let's say up, down, up, down, up, down, up. We came down here. Now, remember I was telling y'all about reversals, but guess what? This got broken, yeah. But look, we made a new high up here. See that? Then it came down and broke. All right. So where's the external range liquidity? Above the highs, below the lows. Above the highs, below the lows. Above the highs, below the lows. Okay. Easy, right? Above the highs and below the lows. Well, where's the internal range? The internal range liquidity can be found at what's called order blocks, fair value gaps, or FVGs. All right. You can see them as supply demand zones. All right. And look what happens. Now, Order now, I'm not gonna go too deep into it because this is a market structure video, but this right here will be an order block. See in between right here, and you have a demand zone right down here. If I stretch it over, price tapped it. You have an order block, you have a FVG there, demand zone here. All right. Now, and to make this even stronger, we a demand zone, a demand zone, supply zone, order block. I trade them the same. All right. Two things they must have: order blocks, supply zones, demand zones. They must lead to a break of structure like this, and they must have a fair value gap. If not, then I don't even mess with it. If not, I don't mess with it. All right. They must have it. If they don't have it, I don't mess with it. I don't want it. All right. But that's pretty much market structure. Um, I could go a little bit deeper into, the internal range and external range liquidity, but I'm gonna save that for another video. All right. Another thing too, you guys saw me drawing when I did my drawings, I would go like this. Understand that each one of these legs have many legs on the inside of them. All right. So we got the big leg, we got that one, and each one of these has smaller legs. All right. And you're going to notice that when you really start looking into the charts. That's market structure. All right. If you guys like this video, please hit that thumbs up. Please hit that subscribe. But before I forget, this is very, very crucial. If you are going to trade the ICC trading strategy, it's very important for you to learn market structure because really that's all it is. Market structure, throwing some liquidity, and boom, you got it. All right. So if you guys like this video, if you find it interesting, if you have any questions, comments, or concerns, please post in the comment section below. Don't forget to hit that link to join my free Discord channel. Share this with about 10,000 of your friends. Subscribe. Holla at your boy later. Deuces.